Friends, now let us understand the second financial statement, and the second financial statement is the balance sheet. So, what is a balance sheet? As we discussed in the beginning of this session today, balance sheet is an indicator of two things about a company. Number one, what are the liabilities of the company? Which means what? Which means from where the company has got money in the business. And number two, it tells you what are the assets of the company. Meaning what? Meaning what the company has done with the capital that it has brought into the business, what the company has done, and that is what assets company has built. So as you can see, this is balance sheet is kind of a snapshot of a business, of a business. And please remember, and I'm sure you would remember, that balance sheet is prepared as on a particular date. So what are the liabilities? Liabilities, very simple, something that the business owe to outsiders. That is your liability. So what is the liability? Liability is something that the business owe to outsiders. And what are the assets? Assets are what a business owns. So the money that company has got into the business, this money company owes to outsiders. And what this company has done with this money, it has created a lot of assets. And assets is something which is owned by the company. And that is the difference you should remember between the liabilities and the assets. Here are certain examples of different kinds of liabilities and different kinds of assets. So please remember, liabilities are divided into two parts. One is known as long-term liabilities and the other one is known as current liabilities. Please also remember, long-term liabilities are also known as non-current liabilities, and the current liabilities in any case are known as current liabilities. Likewise, you also have the assets, and assets are also understood as a current assets and the non-current assets, and that we will understand. Let us look at the liabilities first. So what are the long-term liabilities? There are four long-term liabilities. Number one is shareholders equity. Meaning what? Meaning the money which is put in by the shareholders into the business, that is known as shareholders equity. Number two is the reserves of profit retained. Now what is it? Remember, a business when it starts operating, it will start earning profit. And what a business can do with the profits earned by it? First of all, we need to understand the profit earned by the business belongs to whom? Does this profit belong to the company or does this profit belong to the shareholders? Please be clear about it. Profit earned by a business does not belong to the business. Business has earned it, but it belongs to the shareholders. And why does it belong to the shareholders? It belongs to the shareholders because it has been brought into, it has been earned on the strength of the capital of the shareholders. So that is why what a business will do with the profit which is earned, business can do two things with the profit earned. Number one, it can give that profit to the shareholders as dividend, and number two, it can retain that profit in the business. So if a business has earned, let's say, a profit of 100 euros, now what the business will do, let's say 50 euros given to the shareholders as dividend, isn't it? Because shareholders have put money into the business in anticipation in earning some return. So what the business will do, 50 rupees, 50 euros, it will give to the shareholders as dividend. And this remaining 50 euros will remain in the business, and they will remain in the business and they will reflect in the balance sheet as profit retained, or they will reflect as reserves in the business. Number three is long-term provisions. So what is a long-term provision? As somebody was asking. So remember, what is a provision? Provision is an expense which is likely to incur, but how much it is going to be, you have no idea. So that is why you make a provision. Let me give you an example. There's an automobile company, let's say called Mercedes. Now, Mercedes, when they sell the cars to their customer, they give a warranty. What warranty? Let's say Mercedes will give a warranty to his customer. Tell the customer, in case in next 4 years something goes wrong with the car, you do not have to spend any money. You just bring the car, you just take the car to any of the Mercedes authorized workshops, get your car repaired, pay nothing, and take your car back after the repair. Now you can understand the car is sold today, but the expenses on the warranty are going to happen in next 4 years. Now the expenses which are going to be incurred on the repair of this car in next 4 years, will these expenses be of those 4 years, or will those expenses should be expense of the current year? Please understand, those expenses that will be incurred in next 4 years, they will be incurred in next 4 years, but those are the expense of the current year. And why of the current year? Because the car has been sold in the current year, the income has been booked in the current year. If the income has been booked in the current year, then the expenses also need to be booked in the current year only. But can you do it in the current year? When you are closing the accounts of Mercedes on 31st December 22, can you book the expenses on warranty that will happen in next 4 years in the current year? Answer is no. And why the answer is no? The answer because you don't know what those expenses are. But if you don't book those expenses in the current year, will your current year's profitability be correct? Answer is no. Why? Because you're not recording certain expenses on the warranty which are going to happen in next 4 years. So what Mercedes will do? Mercedes will make a provision on account of warranty. Meaning what? Meaning Mercedes finance department or the accounting department, they will find out in the past how much cost do we incur on warranty. And let's say it comes that 2% of the sales is spent on warranty. So what Maruti will do, what Mercedes will do, Mercedes will make a provision on account of warranty expenses to be incurred in next 4 years, and those will be recorded as long-term provision. So please understand what is the difference between the long-term provision and the short-term provision. Expenses which are likely to occur in next or the liabilities which are to be discharged in next 1 year are known as short-term liabilities, and liabilities which are supposed to be discharged beyond a period of 1 year are known as long-term liabilities or long-term provision. So that's your long-term provision. And then fourth is bank loan more than 1 year. So please understand, how do you difference between the long-term liabilities and the current liabilities? And please pay attention. Current liabilities are those liabilities of a business which are to be discharged within a period of 1 year. That is current liability. What is a long-term liability? Long-term liabilities are those liabilities which are not current liabilities. Meaning what? Long-term liabilities are those liabilities of a business which are to be discharged beyond a period of 1 year. So this is how you will differentiate between the long-term liabilities and the current liabilities. So in case if a company has taken a bank loan and this bank loan is to be paid beyond 1 year, it will be part of the long-term liabilities. Let's look at the current liabilities. In the current liabilities, the first thing you have is accounts payable. Meaning what? Meaning we as a company purchase lot of raw material on credit. Meaning what? Meaning we purchase the raw material from our suppliers, but we don't pay to the suppliers upfront. We pay to the supplier after 2 months, 3 months, 4 months, and things like that. So until the time the material that we have purchased, until the time we make the payment for it, it will appear in our books as accounts payable. And it is a current liability. And why it is a current liability? Because this payment has to be made to the supplier within a period of next 12 months. And that's how it is a current liability. Bank overdraft. So if you have taken a loan from a bank, that we are supposed to pay to the bank back within a period of less than 1 year. So it is your current liability. And current taxation. So if we are making profit and we have to pay tax to the government, and please remember the government doesn't want tax to be paid to them after 2 years, 3 years, 4 years. Government wants the tax to be paid to them within the same financial year. So whatever tax liabilities that we may have is also part of your current liabilities. Now before I go to the current assets, in case if anyone has a doubt, please ask me, else we will go to the asset side of the balance sheet.